day and welcome to FCLT Global's Risk Webinar Series. Thank you for joining us today. This is the 5th episode of our series. Today we're all talking about the subject, time diversification. Is it patience or complacency? As you know from having joined earlier editions of FCLT Global's Risk Webinar, our purpose for convening these sessions is very practical. We want to apply our research in ways that move money in longer term directions through the way that you manage risk. I'm joined today by Dave Turkington. He's just the exact right person to have in this conversation. Dave's an expert on a topic that's necessary for us to understand in this series. Does long term equal long time? That's the essence of time diversification. Dave is head of portfolio and risk research at State Street Associates. State Street Associates is State Street's academic affiliate and the research arm of its capital markets and analytics division. The content that we're referencing today is going to come both from FCLT Global and from State Street. On FCLT Global's end, we center on our 2018 publication called Balancing Act, Managing Risk for Multiple Time Horizons. Some of that information is also cross-referenced in another publication called Institutional Investment Mandates, Anchors for Long-Term Performance. In particular, that will help you think about risk in the contract agreement or mandate agreement between an asset owner and asset manager. Dave very generously has provided some of his slides in advance. You can reference them as well. They are on our registration page. And Dave has a publication from about 8 to 10 months ago called The Realities of Rebalancing, released through State Street in April of 2020, that may also be of use. A few programming notes before we dive in and get Dave involved. Bryn Costello produces this series. She is the other square that you see on this screen. If you have any technical difficulties, or if you have questions for Dave, please submit them to her at bryn.costello@fcltglobal.org. I believe that Bryn will momentarily also provide her email address in the comment box. We will be taking all of our questions through email submission to her. So if you have one, please go ahead and provide it that way. I spoke in error. You may also provide questions rather through the chat function of this Zoom feature. You'll see that we're recording. The reason for that is so that we can archive this on our website. That allows us to go back and use it for research purposes, to share with you for your own implementation, and also to make it available to teammates and colleagues who are in time zones for which this is not suitable. Our webinar lasts exactly 60 minutes. We'll have you off promptly in 1 hour. With that, Dave, welcome. We're excited to have you. I'll go ahead and give you a straightforward question to get us started. What does time diversification mean specifically?
Oh, great way to start off. And thanks for having me today, Matt. I really appreciate it. And great to be with everybody this morning. The way I think about time diversification is really a simple concept. It's whether repeating your bet will control your risk. One period is a single period bet. A long time is a multi-period bet. Does repeating that manage your risk? And the answer depends on what you mean by risk. And it's actually kind of a complicated topic. And the way that I console myself about how complicated it is that Nobel laureate Paul Samuelson got really worked up over this topic over the years. He got so worked up that he wrote a paper with words of one syllable, the entire paper, except for the last word, which was syllable, just to lambaste his critics who he thought were wrong about this issue of time diversification. So he got really worked up over it. It's very complicated. There are different aspects to it, but hopefully we can get into some of those elements.
For sure. I regret that I've not seen that, but I would love to read a one-syllable explanation of the debate on the subject. Let's now get into the real long-term, short-term element of it. In what ways does having a long investment horizon lower risk? And in what ways does having a long investment horizon raise risk?
Right. So the main way that a long horizon lowers risk is that it certainly lowers the chance of loss. So if you want to, if you invest in a portfolio or a risky gamble, even like a coin flip, that has a positive expected return, the more times you play and the more patient you are, the more likely it is, probability wise, that you'll end up with a gain and a profit. So that's absolutely true. And this slide here shows that. There's lore about Paul Samuelson that goes even deeper, which is that he offered a bet to one of his colleagues over lunch at MIT one day, where they would flip a coin and the colleague would gain, say, 50%. In that case, it was a certain amount of dollars or something, but let's put it in portfolio terms here, would gain 50% on heads or lose 20% on tails. So it's a massively skewed proposition in your favor. And the question Paul Samuelson posed to his colleague is, would you play this game? And the response was, no, I can't afford to lose that much right now. I don't want to risk the chance of losing 20% of my money or losing $20 or whatever it was. However, if we can play 50 times or 100 times, I'll take you up on it. So that was the response. And the reasoning is that you're very unlikely to end up with a loss. And if you look at this table here, if you flip a coin one time, there's a 50% chance you're going to get that loss. If you flip the coin 10 times and keep playing, there's a 2% chance you're going to end up with a loss. Paul Samuelson's gripe about this was that you stand to lose more. You're risking more over the long run because you can lose money every flip. And so 10 times your loss is a worse, tail event than 1 times of that loss. So the really simple way to put it, and I think this is the essence of Paul Samuelson's one-word argument, which I recommend to everybody, is that repeating your investment over multiple periods lowers the probability of loss, but it increases the potential size of the loss. And those two effects are quite offsetting. There's a mathematical sense in which they're exactly offsetting. And so Paul Samuelson's assertion is that people in general should probably be indifferent. So if I don't want to take a bet for 1 play, I don't want to take it for 2 plays or 3 or any number of time. I think the bottom line here is that time does not remove risk. It just changes it, right? It reduces the likelihood, but it increases the tail and the severity. Right. And so it's not removing the risk, it's changing it. And I think that means what we need to focus on is studying the long-term risk. We can't just assume it isn't there. And in fact, we have to study it more because it's different than the nature of the short-term risk. So that's how I come at this.
Sure, I appreciate that. Brendan, we'll get you to unshare and then we'll return to the next slide momentarily. But I would like to interject a question here, Dave, and just draw on your experience. I'll give you the predicate for why I ask, though. We talk a lot to behavioral scientists as well in the course of our risk research. We even featured one in the October webinar, many of the participants will remember. And in behavioral terms, it appears that the exact opposite is what actually manifests, that people are willing to play a game multiple times in order to draw down their probability of loss, ignoring the potential for loss. You're experienced in this profession. I'd just like to hear some of your experience communicating this to investors, the way that it's received, any instances that you might highlight as being well received, and any challenges that you might observe in acting on the information you just shared.
Right. Well, I think psychology plays into it quite a bit. It's well known that people have a hard time grasping small probability and extreme events. So even just tail risk in general, I think people tend to err in forecasting things that are very unlikely to happen. So the whole anecdote about, well, how likely are you to be in a plane crash? People tend to overestimate that because it's very salient. But on the other hand, these things are so remote that it's hard to even imagine things that are so unlikely. So I think it's hard to picture this, hard to weigh the risk in its importance, hard to persuade other people to think about it. it's kind of a challenge. I think it's made even harder by the fact that the long run might be someone else's problem in some cases, where
Yeah,
you're responsible for a decision now and you'll be evaluated for it next year, and someone else might be evaluated for it 20 years from now. So there are challenges of that nature as well, I think.
that is interesting. The long run might be someone else's problem is a provocation that we're always well advised to grapple with, right? That gets to the way that organizations work, not just people.
I'm not advocating that's the case, but there is a sort of intergenerational challenge there.
Sure, for sure. Let's get also to what happens in interim periods. I noticed that what you've just shared is the ultimate outcome, but of course, these are multiple bets, as you may say, or of course, all of our audience on the line is holding for longer periods of time. What does time diversification look like within that horizon?
Yeah, I think this is actually the point that's even more salient and maybe easier to inject in a conversation about the long run. And that's the notion that nobody waits until the end of their horizon, if it is, say, 10 or 20 years, and ignores what happens along the way. Everyone, of course, looks at performance and evaluates their strategy and reacts to things that happen on the path to the end. And the problem is that the longer your horizon is, the greater the chance there is that something disruptive is going to happen. You know, think of it this way. What's the probability that a company that you invest in will go bankrupt tomorrow? That's relatively remote. But the probability they'll go bankrupt in the next 10 years, if something bad were to happen, something calamitous, is a much more plausible thing to concern yourself with. So the mathematical way to look at it is just that if you are concerned with the probability of losing a certain amount of money, let's say 10% of your starting wealth, the longer your horizon is, the lower that probability becomes. You'll see in that chart, the light blue dots show the end of horizon probability. And that's what we've been talking about so far. It rises initially because, as I said, it's very unlikely you'll lose 10% in a single month. It's quite likely over 1 or 2 years in this chart. But the longer you push it out, it basically falls to zero. You're very unlikely to lose it. But you become more and more likely to lose that amount of money at some point. At some point, your portfolio may dip below that low threshold. However, it often recovers. That's the corollary to this. So the reason we like this metric is that people design portfolios typically for the end of their horizon to make sure they're comfortable with the amount of risk. But they often benchmark that amount of loss as the total allotment for their investment. So if I say, I don't want to lose more than 10% in 10 years, and I lose that amount in the second year, it sounds really bad. What we're saying is mathematically, that is very likely to happen. Very likely. So of all the possibilities, most of which profit after 10 years, many of them have these interim drawdowns. And the problem is if you don't recognize that high likelihood, you may overreact. If you overreact, you don't even get to the long run. So if you cut risk, during these trying times, you don't get that recovery, which most of the time happens. So I think there's this major disconnect in, budgeting for loss at the end versus budgeting for losses that can occur along the way. And it's much longer along the way. So time does not get you out of that. It actually, it amplifies the chance that some freak event can happen that's temporarily really damaging.
I think that this is a really integral point. I'm going to stay with it for a minute and just make sure that we underline it. Let me make sure that I've understood what you just said correctly. Am I right to understand that long horizons may produce a bigger loss, but that they will produce bigger drawdowns?
They are just much more likely to produce big drawdowns. One simple way to put it is the chance that your portfolio is down 10% at some point is of course always larger than the chance that it's down 10% at the end.
Yep.
It's that plus some.
Yep.
And the plus sum is quite big.
Right.
Than the risk that you had just at the end. That's the first point. I guess the second point is that the longer the horizon, the larger the chance that you suffer a certain drawdown, a particular size of drawdown.
Yeah.
The more time you play, the more possible it is to get an unlucky streak.
So I think our risk professionals, the folks who do this day to day, understand this well, at least likely so. We have to concern ourselves, of course, also with how that's communicated, because risk does not operate as a function alone within an investment organization. This information has to be communicated to chief investment officers, to chief executive officers, and also to board trustees. Do you have a sense about how well this difference between the probability of end of horizon loss and the probability of drawdown are understood by folks who are involved in the investment profession, but not specifically the risk function?
I think something that's helpful here is to put outcomes in concrete terms. The first aspect of doing that, we've already been talking about. So instead of saying risk is some abstract thing called the variance or the standard deviation, and persuading someone, convincing them why they care about that, risk is the probability of losing a certain amount of money is more tangible. So that helps. The second thing that may help is simplifying to a discrete set of scenarios. Instead of saying, well, anything can happen, there's an entire bell curve distribution of stuff that can happen. Let's simplify it to 5 scenarios: moderate, sort of good, sort of bad, really bad, and study those and get the probabilities of those. And it can be, I think, an accurate representation of the full range of outcomes. And certainly the statistics are helpful. But thinking of it in terms of concrete scenarios, I think makes it easier to visualize how favorable or painful those scenarios are going to be. Just making it real. The worst case scenario. And so we've recently been focusing some of our research on trying to define things so explicitly in scenarios and to measure the probabilities of those. I think that's more of a common language to talk about some of this stuff.
Certainly. We appreciate that as well. I think we're now at the core money question, right? This is why we are here. Is time horizon a source of investment diversification? If so, how? If not, why not?
Right. So as we said before, repeating your bet exposes you to larger losses. So it's different than diversifying across a portfolio. One way to think about it is, if you're investing just in, let's say, stocks and bonds, would you rather be 50% stocks, 50% bonds all of the time, or 100% bonds and 100% stocks half of the time each? So you'd think, well, is it diversifying to just, switch off and keep repeating these things? Not really, because, in the time that you happen to be in stocks and the market happens to fall, you're not diversified at all. So the diversification needs to happen coincident to the losses that you're having. So that's why this notion of repeating your investment bet doesn't really diversify, because you're taking a new bet each time. You're not offsetting or spreading your bets across something. You're just repeating them. So it's fundamentally different. And that's why the magnitudes grow. And that's why it's very different to think about diversifying a portfolio across its assets. An interesting question, though, is how do we diversify a portfolio across assets for different time horizons? If I say, well, what's the most efficient blend of risk for the next month, that may be quite different than what's the efficient blend of risk for 10 years or 5 years or 1 year. And part of the reason why is that correlations are quite different depending on the horizon you're talking about. This is a dramatic, contrived illustration, and then we can show a real illustration that affects portfolios. But both of these charts here show cumulative performance of assets that are 50% correlated to each other. So they're 50% correlated month to month. And if you took this data in Excel, you would see that right away. The difference is that 2 of them drift up together over time and 2 of them drift quite apart. And this has to do with their lagged interrelationships. One is zigging after the other zags. And if you don't think about that longer horizon dynamic, you miss the point. So when we actually just go and calculate, what's the diversification of a portfolio on 1 month versus 1 year, they can be really, really different. And that's also true just of risk of assets. So I'll give one really simple example about an individual asset is that bonds are riskier in the long run than you might think, because interest rates move in persistent cycles. So bonds have a tendency to repeatedly gain to huge gains and repeatedly lose to large losses. But month over month, the moves are small. Currencies tend to be the opposite. Month over month, they fluctuate like crazy, but they tend to mean revert because no currency just grows to dominate the entire planet. So there, your risk in the long run is much smaller than it is in the short run. And it gets nuanced for other asset classes, but there's always elements to the trending behavior and what that means for risk.
For sure, for sure. You tempted us with a real world scenario. Let's go to that.
This is what got us interested in the problem. And if you go to the next slide, which shows the scatter plots, it's US stocks versus emerging market stocks, just the headline indexes. What we found, we started doing this research, I think in 2013 or 2014. And at the time, there was just huge dispersion in the performance of US stocks and emerging market stocks over the last 3 years. They weren't anything like each other. And yet month to month, they appear to move in lockstep. So if you just look at the monthly returns of these, foreign emerging market stocks and US stocks, they're about 70% correlated month to month. And it's all risk on, risk off behavior. But if you start to look out over longer horizons, they're less tightly coupled. There's more dispersion there in the actual annual returns. And in the 3-year returns, if you're going to invest for a 3-year horizon anytime over the last 40 years, you could have got any of those data points. So in some cases, US and emerging markets did well together. But in just as many cases, emerging markets were pretty much flat while the US did well. And the even worse part about this is that when they fall together. So they don't necessarily rise together, which is what you would like, but they do fall together. And that's the risk part. And you can see that in the left tail. So this picture on the right-hand side, I think as a risk manager, is very different than the picture on the left-hand side in terms of the nature of that risk and whether there's diversification or not. I think the problem is that it's so easy to get high frequency data. We're kind of bombarded by, we have daily returns, monthly returns, bank statements, arrive daily and monthly and stuff like that. It's easy to fixate on the short term. And it feels like, well, you have this wealth of data about the short-term moves. The problem is that you can't just extrapolate to the long run. There's a bunch of other stuff that happens on the span of years. It's harder to measure, I think, because it feels like, well, we don't have that many long periods in the historical data. I think it's just useful to probe that for information and think about if it starts to break down what the higher frequency it looks like. And in this case, it does. So these are just actual outcomes. If you think you might get one of these picked at random, how are you going to manage your portfolio?
I know that we have a couple of more images that we want to present here, but I am going to pause here and just underline what I think the 2-word answer to the question is. Does time diversify? It depends, and not necessarily. Is that right?
Pretty much. I think it changes the nature of risk.
Yeah.
I don't think it proves it. I think
it's not something to take for granted. We cannot assume that longer holding period equates to that.
One interesting side note on this, and we actually, in the book we wrote a few years ago, we have a chapter on this, and we talk about, well, what does this mean for the common wisdom of investing in stocks when you're young and having a safer portfolio as individuals investing for retirement? And I think a lot of people might assume, well, you should take a lot of equity risk when you're young because of the time diversification. And here we're saying, well, that's not really the case. But it still makes sense to do that because you have, of course, your human capital, you have your earning potential, which is an offsetting asset to the risk you're going to take in the financial portfolio. So, I think that wisdom holds, but it's because of your earning potential and your natural diversification as a person, not because the risk of stocks is very, very low. Another interesting point for this, of course, is the survivor bias of data and the fact that when we look at the US stock market, it is the market that's done the best over some long period of history. And so, is it reasonable to conclude that that will continue forever? That's sort of an open philosophical question. But again, we may be underestimating the risk that things don't work out over a decade period.
We've got an important reminder from a member of the audience, not just to think about how we define time and think about time, but also how we define risk. And the particular question is risk in terms of meeting your objective, or is risk in terms of just avoiding a drawdown? How would you address that definitional issue?
I think that it should be in terms of your objectives. It can be hard to specify that, but portfolios exist for a reason. They exist to preserve and grow wealth, and presumably use it for something. So if you want to have the most wealth at the end of the horizon for spending purposes or whatever, then you might look at something like real growth, net of inflation, and maybe that's the actual objective. Of course, there's lots of cases where there are interim spending needs, and this is an interesting one for Horizon as well. So maybe the case that you have, and as an institution and as a individual, there's so many examples of needing to spend along the way, and that's equally important. So a challenge there obviously is, we were talking about the within horizon drawdowns before, that impairs your ability to meet your short-term goals and your medium-term goals if you can't liquidate parts of the portfolio or meet those short-term spending. So I think investors probably care about the long run and the medium and the short run. It's not one or the other. I think one of the fundamental points here is that those two are actually in conflict. You can't necessarily minimize risk across the board. And the simplest way to look at that is, what's the safe asset for the short term? It's cash. What's the safe asset for the long term? It's long-term government bonds, really. I mean, cash as a long-term investment is actually quite risky. So you can't have it both ways. And there's interesting examples of that, I think, going beyond it. If you look at, you look at equities, they are going to have a larger expected return. So they're going to have less drawdown risk, in the very long run against, let's say, an inflation objective, but they're going to have a lot more risk in the short run. So I think most investors need to balance those two factors, that both horizons are probably relevant, but to different extents. Of course, there's also, in terms of defining risk, there is a relative pure risk that is material for a lot of folks. So, you not only need to preserve and grow your actual wealth, but you may need to outperform your competitors. And that could be a very real thing. This came to the forefront for us many, many years ago, talking with endowments, university endowments, where they need to compete for talent and for students and for things that are in short supply. And so they need to have a good financial position. So it's not enough to just make money. I mean, they have to sort of outperform their peers. And I think that dynamic exists for almost everybody. And that means that there's this trade-off between doing what you think absolutely meets your goals and following the crowd a little bit. Because too much of a maverick, even if you're right, when you're wrong, you're going to get punished very severely. We like to say it's very painful to be wrong and alone. You can be wrong with the crowd, and you can be right, but you don't want to be wrong and alone.
Understood. Also, just to underline for our audience in the room today, this aspect of risk across multiple time horizons is the cornerstone element of the work that FCLT did in 2018. We heard that from our members, including State Street and others who we have in the room today, that you have to, of course, fulfill your purpose. You also have to manage your pathway, that there is some tension there, and that the core function is how you navigate trade-offs that are associated with that tension. There is one follow-up question to this, Dave, and it has to do more with the return element than the risk management element. We've talked about how probability and possibility change over time. Are there upside implications to that in addition to downside implications?
Definitely. Obviously, patience has a lot of potential payoff, right? And if you can buy distressed assets, or if you can do successful value timing and buy things at attractive prices, you're going to win in the long run. I think a lot of those opportunities exist. They're not without their own risk, of course. If you fail at that kind of timing, you could inflict more damage. But there's a real opportunity there, and probably something that presents more to long-term investors who have that patience and that flexibility that's not really accessible by the shorter-term ones. So it's worthwhile to do it. Yeah, I guess I would point out on the risk side of that, and this gets into that rebalancing paper that you mentioned at the onset, is that you might think that buying the dips, if you will, is a good long-term strategy, and certainly it is. But the risk manifests when the dips keep going. If they're really severe, I think you've hit the bottom. What you're basically doing is doubling down, and then you can lose more. And so there's this actual dynamic of frequent rebalancing means buying risk into the sell-off and selling risk into the gains, right? So if you actually simulate that out over a many period horizon, you see this dynamic that in the event that the market has a prolonged series of losses, you have way more tail risk if you kept rebalancing the whole time, because you were adding your risk back and it kept falling. It would have been naturally curtailed, right? If you didn't do anything. You would have lost money, but then the next 50% drop would have only cut that small amount by half. So compounding sort of compresses your losses, but if you rebalance a lot, it doesn't. So there's a way to profit, and on average, when things do mean revert, you can make huge gains. But it's not sort of a set and forget strategy that just mechanically rebalancing will manufacture some alpha. It has this sort of tail risk that, again, to our point before, is rare, but when it happens, it's amplified. So I think there's a lot of, I know you start off, we were supposed to be talking about the upside, and I can't stop thinking about risk, but I think there is an attractive upside. Another point to that question may be, who's setting the price of risk? Again, if we say there's different risk over different horizons, in principle, and probably to a large extent, markets are priced according to their risk. And if everyone is a short-term investor and they think something is super risky, then it's going to command a high premium. But maybe it's not risky in the long run. So now if you're a long run investor, you get that juicy premium for being patient in the short term, and you don't actually have the risk in the long run. So that's, I guess, the optimistic side of it, is which assets are overpriced by other people that care about the thing that's not your primary concern. And I'm sure those opportunities exist.
I really appreciate that. I'm going to insert a programming note and then prompt you once more on a return element of this, particularly with respect to the drivers of long-term versus short-term return. You have a terrific image of that I'd like to call up, Bryn. That will be slide 8. But before we take Dave there, let me just remind everyone in the room that we are taking questions. We've already received 2, as you've seen, to bryn.costello@fcltglobal.org. So if you also would like to speak up and ask something to Dave, please go ahead and do that, or insert it into the chat function of our Zoom platform. That said, Dave, of course, I've had a preview, and anybody who wants to go to our website can also have a preview of the images that you put together. And I know that one of them really gets at this intersection of risk and return when we think about long-term drivers. Could you share with us how that intersection is manifest in the image that you've compiled here?
Yeah, so what we looked at here was what aspects of pricing, if you think about a dividend discount model, something kind of simple. The price of an asset is its future cash flows discounted by discount rates, how much people require to compensate for risk and so forth. Which of those components is actually driving the dispersion in returns? So in this case, we looked across U.S. sectors, and we looked, every month, and really the beta, the riskiness, or the discount rate drives most of the performance differences, let's say from financials to technology and discretionary and so forth, on a monthly basis. It's all about what's risky now or what's become safer. Fundamentals, changes in earnings on a month-to-month basis, are sort of a blip around this crazy noise of risk preference. But when you broaden your perspective to the long run and do the same thing, we're looking again across the different sectors, what explains why a sector did really well in the last decade and another one did really badly? It's fundamentals. It's things like earnings. So if you rank their returns over 3 or 10 years against their financial performance, you get a pretty tight fit. And people care much less on that horizon about how risky they are. Are they riskier now than they were 10 years ago? It matters a little bit, but not that much. So what this implies is the drivers of risk are quite different on different horizons. We can reconcile it to, they're trending over time. They sort of trend towards the fundamentals, but there's huge variation along the way. Do you care about the trend, or do you care about the variation along the way? And as we said before, both matter. They absolutely both matter. But the nature of that risk is different. I think it's interesting also to take this one step in the other direction. If we go very high frequency, like daily or intraday, the dynamics that affect risk there are also totally different. It's like news announcements, supply and demand, technical. So
right.
On different horizons, the things you might want to focus on to measure risk are completely different. And another piece I think is interesting to bring into this is the whole notion of sustainability and ESG,
right,
which again is relevant on many different time frames, but sustainability by its natural concept is very much about the long run. And it's saying, well, those things matter a lot in the long run, and people might neglect them in the short run because, yeah, maybe something else is more important. It won't be permanent, but it will matter right now. If you expand your perspective, maybe you shift your weight towards those things. So again, I think it ties into this idea that the nature of the analysis, the nature of the scenarios that you want to analyze could be different. And the data that you use could be completely different.
Sure. That's an important point as well. At the risk of exposing my own ignorance, I'm going to try to bring this into a real world application, one that I know is on the minds of everyone within our membership. We've talked already about how holding for a long period of time increases the likelihood that you'll encounter some sort of disturbance or turbulence along the way. One in particular comes to mind. Over the past year, we've had a major financial and economic disturbance, although relatively short-term in nature, created by the coronavirus public health and epidemiological crisis. I'm curious how a market disruption like the one created by coronavirus exemplifies risk and opportunity for long-term investors, what we should learn from it and apply it to what we've already learned today.
It's a tough one. It's a tough one. There's so many surprising things about this episode and this crisis. I think very few people expected the market to bounce back so strongly off of the lows. And, that paper on rebalancing we did was in early April, late March, when it was really uncertain what direction stock prices were going to take. And all the questions from a practical perspective were about what to do about the equity allocation. Do we rebalance it or not? And so those things matter a lot. And it's always easy with hindsight to be critical of decisions and say, well, it, it would have been so easy to get that right. But there was really a ton of uncertainty. Obviously this seems to have rewarded a patient kind of long-term perspective in how quickly things recovered. But then obviously we have this huge divergence of the real economy, which has struggled in its recovery versus prices. So yeah, I think it's a dangerous game to be overconfident on the timing side of things, timing the market. But I think let me just say it reveals, I guess, two things: that patients can pay out, and some of those short-term drawdowns can recover, and also that they can happen, and they can happen in ways that nobody really anticipated. So that was a stress to the system that people probably didn't anticipate, and it was swifter than it has been in most periods of history. So being prepared for that sort of shock is helpful.
Mm-hmm.
So you don't, you don't have to overreact to it. I guess if you weren't prepared for that sort of risk and you overreacted and you had to cut all your positions, that would have hurt because you would have missed out on the recovery. And so making sure you can withstand the shocks to actually weather the storm, maybe it's a lesson in how that can be helpful.
Let me see if I've connected a dot, and then I'm going to go toward the rebalancing work that I know that this crisis triggered for you and for State Street. Earlier in the conversation, though, we saw mathematically how your drawdown within an investment horizon can be significantly greater than the risk of coming up short of the objective. Is what we saw in March of last year an example of that?
Definitely. That is probably a textbook example of a within horizon drawdown, just in terms of how quick and how severe it was. I will point out that what we showed earlier for the probability of drawdown versus end of horizon was actually a little bit of an underestimate of risk, because we didn't account for how violent and turbulent things can get during these kinds of events. So what I showed earlier was based on one, nice normal distribution in a very orderly sense of markets that doesn't really exist. Even there, the drawdown risk is high. If you add to that a model where things can slip into a very sort of turbulent and negative aspect, where assets become more correlated to each other when they fall, and they fall more dramatically, your within horizon goes through the roof even more. So I think this is an example of how sharp things like that can be, and how they're often in the short term. But again, you never know at the time how persistent some of these things are going to be. But I think it is a real world example of that. Yeah.
I'm going to jump in on that point because I'd like to dig into it a little bit more deeply. Again, just to remind everyone in the audience, we're now entering the last quarter of our time with Dave. So please do go ahead and get in any questions that you might have. Dave, you of course make the point just then that this looks very evident what the long-term and just profitable behavior would have been in retrospect, but you don't have the luxury of making that decision in retrospect. You have to make it prospectively. I know that the experience in real time prompted a lot of thinking on your part and on State Street Associates' part about rebalancing. And as you, of course, know, these are things to which an investor might pre-commit by having an automatic rebalancing policy, or that they might make more active decisions about. Can you talk about the way that rebalancing connects to the issues that we've discussed today and share some insights that you've learned?
Yeah, great question. Pre-commitment, I think, can be a useful mechanism because it's a disciplined thing, and it takes the emotion and the that kind of aspect out of it. So it's easy to maybe overreact or view things too passionately in the moment. So there's something nice about thinking during very calm times and pre-committing to some disciplined behavior. I think what became not that that's the only way, obviously. It's good to evaluate the circumstances, but when we started to reflect on that, we came across a lot of viewpoints, and I think there's a lot of research that sort of implies that rebalancing and discipline is a free lunch. That if you have this kind of discipline, setting aside transaction costs, let's just assume you don't even have those, but if you could constantly true up the portfolio to be exactly how you want it, that would always outperform or be better. And I don't think that's the case. Again, I think that the rebalancing rules you choose will shape the distribution of outcomes. They might shrink the tail risk, they might expand the upside, or they might do the opposite. But they don't generate a free lunch return. And that's even without costs. In our simulations, and we looked at it a lot of different ways, we looked at the ways markets have crashed in the past. We looked at stylized simulations of, how that could happen in every formulation. And if you're super aggressive in rebalancing, then you chase the market down once in a while, and you have large losses. And they're worse than other people would get if they did nothing. So obviously there are times when you benefit. If you have a coronavirus type V-shape of stock returns, you're going to benefit from rebalancing. So the interesting thing is that I don't think there's a free lunch. Anything can happen and probably will happen at some point. So what's the spectrum of outcomes, and what kind of risk are you taking? So I think it's a bit of a fallacy that frequent rebalancing is the safest thing to do. If you have a long-term horizon, it can end up exposing some of these incremental risks. So we looked at things like tolerance bands. You want to let some of that play out. Maybe if markets drop by more than 5%, if your position drops, I should say, by more than 5% off the target, then you would bring it back. And so it's interesting to just compare these different things. And again, to my earlier point, to look at specific outcomes. If you do a simulation, you see, these are actual outcomes that could have happened. And what are the 5% worst cases? And am I comfortable with that? And what are the 5% best? So it really prompted us to rethink this, because I think the rules of thumb may be a little simplistic in some cases, and missing a few of the unintended consequences of those rules.
I appreciate that. To rephrase it, that sometimes there's an impression, I think, that rebalancing is something that is got a right answer, right? That you can know what to do with rebalancing. So I'm going to ask a question, and I'm purposely going to frame it provocatively, but hopefully draw the contrast. Is it the case that an investor's rebalancing decision tells us more about their intellect, or tells us more about their risk appetite?
I like the question. I think I've come to the view that rebalancing is a very personal decision for a portfolio, and it should be matched to the risk appetite. So yeah, I don't really think it says much about the intellect. I think it should reveal a lot about just preferences for return versus risk, amount of risk appetite during drawdowns, things like that. I don't think there's a one-size-fits-all solution.
There's another question that's come into the audience. I had an oversight. There could be another thing that it tells us, and that is it could tell us something about the confidence within the team, and particularly the team's confidence in decision makers. You alluded to something much earlier in the conversation that I would like to loop in at this point, and that is the very short-term nudge that surprise can create, right? And who is surprised? So let's add in that third option. Does a rebalancing policy or the broader issues that we've discussed today tell us something about the team's confidence in itself and the strength of their communications about risk across different functions?
Yeah, that's a really great perspective. I guess I'm looking at it and maybe I'm misunderstanding the comment, but looking at it in two different ways. I mean, one is sort of a discipline confidence that, if if something bad happens that nobody expected, and this maybe is to your point of surprise, then the people who are managing the portfolio come under fire, and they're forced to do something, and maybe they have to overreact because of that pressure or something like that. So that the trust could manifest as discipline. If people trust the team and they expect that certain losses could happen, but they'll be managed well, then it prevents overreacting. And I think that could very much be a part of it. The other way that I could interpret the point is that sometimes there may be tactical decisions that have high conviction. So, a team may understand that, well, we think we understand the drivers of the current market and it's a temporary thing. So we're going to, double down on these assets because we think they're undervalued. Right. And that level of conviction in a view can be powerful, and that creates the upside. So I can see it in two different lights. And again, maybe I've misinterpreted it, but I think it's really interesting.
Your interpretation, by definition, Dave, is the right one, because we're interested in your expertise today. We're moving toward conclusion. I'm going to try to get in two more questions. One that continues what we're talking about right now, and then one that goes toward conclusion. One thing that really jumped out at me as I was preparing for our conversation today is that the moments that most call for long-term focus when you're managing risk are also the moments in which behavioral scientists would tell us that it's most hard, most difficult to maintain that focus. When you're feeling loss averse and you feel like a certain mental account has been drained. We've talked in great detail about one way that you can control that behavior, rebalancing either by policy or more active decision-making. Have you seen other ways in which long-term investors control their behavior over time when they encounter these drawdown moments?
It's a huge challenge. It really is. I think preparing for it is probably one of the best strategies, because it pays to contemplate these things when you're not in the heat of the moment, and I think also to set expectations, as we were saying about this is right. How bad it could get, and to be less surprised if that happens. It's always, I guess it's always tricky though, because markets are uncertain and we never really understand the world we're operating in as investors. So there's always the possibility that your fundamental concept is wrong. There is always that possibility that I've just completely misjudged the market and the best strategy, and my portfolio's performance is evidence of my failure. And so it's really difficult, I think, because you can never rule that out. So I think one defense against that is preparing ahead of time for the severity and the nature of what could happen. Another one perhaps is just having a lot of different viewpoints. So there are a lot of people involved, and it's not just, one person's emotional reaction to something. It's maybe it's hard for people to read something dispassionately, but if you have maybe a good group of people, that you can counterbalance some of that, and you can have really good debate. And I think that's probably quite helpful too.
Sure, I appreciate that. Just to underline that point, it connects to the way that diversity is a matter both, of course, of values, but also of value. And that's a topic that's increasingly rising as a theme in our research as well. I'm going to bring us to conclusion with a question, and you can take it in whatever direction that you want. Let's cap it off. Is it a long-term practice for investors to take a mindset of time diversification?
Is it a common current practice to take that mindset?
Is it a long-term? Is it a long-term practice? Is time diversification by definition long-term, or what would you characterize the long-term practices as being?
Yeah, I think long-term, the issue of how time impacts, the set of things that can happen is just a fundamental aspect of being a long-term investor. I think the further we look in time, the foggier it gets. Trying to look ahead things get really murky and hard to predict. And so that's kind of the nature of it. I guess where I come down on it is it doesn't mean that you shouldn't try. There probably are things that you can learn to just make better decisions about the foggy, uncertain, distant future, and it's probably worth trying to do that. And even I guess what I would end with there, I think it's in this time diversification, the impact of time is a fundamental aspect of investing. It's always going to be there because you're always investing for some span. The final thing I would end with is maybe it doesn't always have to be perfectly precise. It's going to be hard to be precise about anything that's that far away. But to be directionally correct, I think can be very important. And in some of these examples that we found is there may be a bias. There may be a bias that I'm underestimating risk. And recognizing that just in direction, even if you're not sure the exact extent or bias of diversification, and maybe the distribution is not quite as tightly coupled as we thought, that's sort of a directional thing, and we can reflect on that. So there's this huge cloud of uncertainty. The further you go out, I think the harder it is to parse. But directionally, there are adjustments, and I don't think those adjustments are always made. I think sometimes we make convenient assumptions about what will happen in the long run, and tweaking those and challenging and stress testing that thinking is probably the best practice I can think of, because trying to get perfect precision is likely not attainable. So, I don't think it's a futile thing, but we should have realistic goals.
Yeah, that's good work if you can get it, isn't it? Dave, I want to thank you for being part of our conversation today. Of course, for everyone in our audience, Dave Turkington from State Street Associates, Head of Portfolio and Risk Analytics. We really appreciate you. Thank you for being part of our conversation today, Dave.
Thank you so much.
I also want to make a point of thanking Bryn Costello. She's the graphic square that you see on your screen, producer of this series, and the person who makes all of the conversation possible that you see today, and in all of our episodes for that matter. Let me go back to our purpose moment. The reason why we have these webinars is to apply our research, and of course the research of others, in a way that allows you to manage risk in a longer term manner and ultimately move money in longer term directions. To further fulfill that purpose, we're available to you after the conclusion of this webinar and at any moment to talk about the implications and the implementation of this research. You can find all of the research that I mentioned today on FCLT Global's webpage. That is fcltglobal.org/resources. I would emphasize that includes the slides that Dave presented today, which are available on the event registration page. We do these webinars monthly. They are on the second Wednesday of every month. Our next session, accordingly, will be on February 10th at the same time. This is a first order importance topic. Next month, we will be talking about the ramifications of investment risk management on income volatility and income distribution for individuals. Let me conclude again just by saying thank you to Dave, thank you to Bryn, and of course, thank you to all who joined us today. We appreciate you being with us. That concludes our webinar, and we will see you on Wednesday, February 10th. Goodbye.